Wow, this is crazy. Welcome to The Explainer, everyone. Today we are looking at one of the most polarizing, mind-bending stocks on the entire market right now, Strategy Inc., trading under the ticker symbol MSTR. If you have been watching the charts, you have seen their stock price completely plummet by 45% this year. That kind of drop is creating massive panic among retail investors. People are freaking out, wondering if this is the end of the line. So let's bring in our chief analyst to break this down. What is actually going on here? If you look at the data driving this massive sell-off, there are three real fundamental causes hidden right behind these alarming news headlines. First, we are seeing a brutal accounting rule change that is completely masking their actual cash flow and operational health. Second, they are buckling under the massive structural burden of their own high-yield preferred stock dividends. And third, the company is executing a historic, fundamental pivot from simply hoarding Bitcoin to actively authorizing its sale. Wait a minute, doctor. Before we get into all those complicated financial details, what does this company actually do? For the folks at home who aren't familiar, what is their actual business model? Let me give you a very clear picture based on their corporate structure. Fundamentally, they are a steady, slow-moving enterprise software train that decided to strap a highly volatile multi-billion-dollar Bitcoin rocket engine directly to its roof. They operate a traditional software business, but they use the cash and leverage from that business to operate as a massive Bitcoin proxy. So what you just said basically means they are a boring tech company that decided to YOLO into crypto to spice things up, and now they are dealing with the consequences of that rocket fuel. That is factually correct, and the data we will review today will show exactly how that rocket fuel is currently performing.
Okay, so here is our exact roadmap for today's explainer. First, we are going to look at the $60 billion Bitcoin paradox. Second, we will be unpacking the deficit. Third, we are going to explore the digital credit moat. And finally, we will break down three future survival scenarios. Let's get right into it.
Section 1. The $60 billion Bitcoin paradox. Analyst, take it away.
We must begin by looking at their most recent financial filings, because the numbers are staggering. Strategy Inc. recently reported a massive $5.4 billion operating loss for the year 2025, alongside a net income of negative $4.2 billion.
Wait a minute, doctor. $5.4 billion in losses? Are they going bankrupt? What does that have to do with our stock accounts? Why would anyone in their right mind invest in a company that appears to be bleeding over $5 billion?
The data requires careful interpretation here, because that $5.4 billion operating loss is not actual cash flying out the window. It is primarily an accounting artifact. When we look at their statement of cash flows, their actual operational cash burn from their core software business is not reflecting anywhere near a $5 billion deficit. Their day-to-day business of selling software is actually stable. The massive negative number you see on the income statement is a non-cash impairment charge related to their treasury strategy, which we will analyze shortly.
To prove that they are not going bankrupt, we just have to look at the other side of the balance sheet. Despite that massive paper loss, their total assets sit at an astronomical $61.6 billion, with total shareholder equity sitting at $44.1 billion.
Oh my God, really? So they look completely broken on the verge of collapse on their income statement, but they're actually sitting on a massive mountain of wealth?
Exactly. However, it is crucial to understand the composition of that wealth. That $61.6 billion is not tied up in real estate, intellectual property, or traditional liquid cash reserves like you would see with Apple or Microsoft. It is almost entirely concentrated in one highly volatile digital asset.
This perfectly illustrates their balance sheet concentration. They are currently holding and accumulating over 843,000 Bitcoin. To put that into perspective, that is roughly 3.9% of all the Bitcoin that has ever been created in the history of the world. Wow! So they just bought an absolute ton of crypto? When did this happen? If we look at the historical data back in 2020, their executive chairman, Michael Saylor, executed a massive strategic pivot. At the time, their software business was generating cash, but struggling to find aggressive, market-beating growth. So management decided to use their remaining corporate capital to buy Bitcoin when it was trading below $10,000 as a treasury reserve asset. Today, the execution of that strategy has officially made them the largest corporate holder of Bitcoin in the entire world. So what you just said basically means investors aren't actually buying this stock for the software anymore. They are just using this company as a backdoor way to trade Bitcoin on the stock market. That is precisely what the market data indicates. The market now treats their corporate securities almost identically to a leveraged spot ETF, giving traditional equity investors direct leveraged exposure to Bitcoin's price action through a publicly traded entity.
Moving right along to Section 2, unpacking the deficit. We need to figure out where these crazy numbers are coming from.
I know what everyone at home is probably thinking right now. They are making good money on their software, and they hold billions in crypto.
So why is the market going wild when they are running such a massive multi-billion-dollar deficit? If they aren't actually burning $5 billion in physical cash every year to keep the lights on, where exactly is that terrifying number on their earnings report coming from?
It all comes down to strict regulatory compliance and a very specific change in how digital assets are reported by corporations. Adopted on January 1, 2025, the Financial Accounting Standards Board, or FASB, implemented a new fair value accounting rule. This regulatory change forces companies to record massive paper losses whenever the price of Bitcoin drops, even if they haven't actually sold a single coin.
Wait, so they get penalized just because the price fluctuates on a given day?
Yes. The rule explicitly requires that the carrying value of their Bitcoin treasury must equal its exact market value at the very end of the reporting period. So when Bitcoin's price plummeted 52% from its all-time peak of over $126,000 down to below $59,000, Strategy Inc. was legally required to report those unrealized losses straight onto their income statement.
So what you just said basically means the $5.4 billion operating loss is literally just a phantom number on a spreadsheet because Bitcoin took a dip before the quarter ended?
That is correct. It is proven by the numbers that the operating loss is directly correlated to the macro crypto market downturn, not a structural failure of their day-to-day software business operations. They didn't lose $5.4 billion in cash. The value of their holdings temporarily depreciated by that amount.
If you look at the data here on this table, you can see the stark contrast between their two operational arms. Their core software business is actually growing steadily, but it is completely and entirely eclipsed by their aggressive capital market activity. To be specific, they raised $11.7 billion in just 4 months strictly to buy more crypto. Wait a minute, they raised $11.7 billion in 4 months? That is absolutely insane. The software is just a side hustle now? From a revenue scale perspective, yes, but it is important not to completely ignore their software engine. The data shows their subscription revenue actually increased 59% year over year to $58.9 million in Q1 2026. This was driven primarily by their new product, the Mosaic Universal Semantic Layer for Governed AI. Governed AI? That sounds too complicated. Could you give a simple analogy? Certainly. Artificial intelligence models, like large language models, are amazing at generating text, but they are notoriously terrible at deterministic math. If an executive asks an AI to calculate complex quarterly revenue, the AI will often hallucinate and invent the wrong numbers. Strategy Inc.'s software acts like a strict calculator that sits behind the scenes. It handles the hard, reliable computation, while the AI handles the natural language explanation. It is a highly effective, solid business model. Okay, that makes sense. But still, $58 million versus $11.7 billion. Exactly. A $58 million software revenue is just a drop in the bucket compared to the $11.7 billion they raised in capital markets just this year, which officially made them the largest U.S. equity issuer in the market. Their true business is now capital formation.
Let's move on to Section 3, the digital credit moat. This is where things get really wild.
Based on their brand new digital credit capital framework, the company is executing a deliberate 3-step financial process. First, they are leveraging their reliable software revenue and taking on massive corporate debt to relentlessly accumulate Bitcoin. Second, they are issuing perpetual preferred stock, known under the ticker STRC, to generate yield for investors. And third, they are establishing a US dollar reserve to manage their dividend payouts and liquidity. Wait a minute, doctor. Leverage, perpetual preferred stock, USD reserves, that's too complicated. Could you give a simple analogy for our viewers? Think of it like a real estate developer taking out a massive mortgage to buy an entire gold mine. Then, instead of mining the gold, they issue high-yield bonds to traditional investors, promising to pay those investors a massive interest rate funded by the future appreciation of that gold. Strategy Inc. is transforming digital capital, the actual Bitcoin, into digital credit. They are acting as a bridge between the crypto world and traditional finance.
And the data shows they are paying an absolute fortune to build this bridge. Their STRC perpetual preferred stock offers a massive $11.52 annual dividend per share, which yields over 15.4% based on its pricing.
Oh my God, 15.4% yield? That is a massive payout. Who is buying this stuff?
Institutional investors. They successfully raised $10.5 billion just from this specific STRC offering, making it one of the biggest preferred equity offerings in history. This financial instrument is perfectly designed for institutions seeking steady, predictable income. It attempts to eliminate the day-to-day volatility of holding pure Bitcoin while still allowing those funds to profit from Strategy Inc.'s overall crypto leverage. They have built an incredible economic moat because no one else has the treasury size to offer this kind of crypto-backed yield to the traditional market.
Okay, so they have a massive moat, they raised billions,
And they are offering huge yields. That sounds great on paper, but it forces me to ask the ultimate question. If the yield is so high and the strategy is supposedly working flawlessly, why did the stock drop 45% this year? Usually a 15% yield has income investors lining up around the block begging to buy in. The answer to that lies in the fatal weakness of this entire model, which is structural risk. The broader market is finally waking up to the mathematical reality of funding those massive dividend payouts during a severe crypto market downturn.
As the data clearly demonstrates, leverage is a double-edged sword. On one side, when Bitcoin rises, the gains are multiplied exponentially. That leverage is exactly why their stock soared so incredibly high originally. But on the flip side, when Bitcoin falls 52% from its peak and is currently sitting below that critical $59,000 threshold, the leverage severely exacerbates their losses.
So what you just said basically means the leverage works like a dream until the market flips, and then it becomes a total nightmare.
Precisely. If we look at the numbers, the cost of funding a 15.4% yield on $10.5 billion of preferred stock is staggering. It requires well over $1 billion a year in cash outflows. Their debt and preferred equity obligations do not magically shrink just because Bitcoin's price drops. This deep, structural misalignment of risk is exactly what caused the 45% drop in their share price. The market has rapidly lost confidence in their ability to sustain those massive cash payouts without taking drastic, potentially damaging measures.
And this brings us directly to their brand new pivot. This is the drastic measure management is taking to fix this liquidity crisis. They are officially shifting away from their pure, uncompromising strategy of Bitcoin accumulation.
Wait a minute, are they actually selling? The famous diamond hands are folding?
According to their latest filings, yes. They are actively managing their liquidity by authorizing actual sales of their Bitcoin. They have officially approved up to $1.25 billion in Bitcoin sales, alongside $2 billion in share repurchases. This is a historic, fundamental shift for the company. It is no longer a hold-at-all-cost strategy. Management is realizing they must generate fiat liquidity to make sure they can pay their massive dividend bills and keep the lights on. This leads us to our final segment, Section 4, 3 Future Survival Scenarios. Where does the stock go from here? Based strictly on this new digital credit framework and their balance sheet data, we can forecast 3 distinct scenarios through the end of 2026. We begin with the highly optimistic bull case. The specific precondition or trigger here is that the macro environment shifts and Bitcoin quickly resumes its aggressive climb to new all-time highs.
And if that happens, they are back in the money?
Exactly. If that trigger occurs, their capital market leverage works its magic perfectly, multiplying their gains without draining their newly established US dollar reserves. The STRC preferred equity would see massive demand and trade close to its $100 targeted stated amount. The ultimate outcome is that Strategy Inc. successfully sustains a massive Bitcoin per share expansion. The stock price reaction would be overwhelmingly positive, likely exceeding previous highs. However, the data clearly shows this relies entirely on a macro crypto bull run that the company itself cannot control. Next, we have the base case, which is the neutral and, frankly, the most likely future based on current market data and volatility metrics. The trigger here is that the Bitcoin price simply stabilizes with moderate sideways volatility. So no crazy spikes, but no massive crashes either? Correct. In this scenario, management successfully uses their new rules to fix the leaky ship. They carefully execute on their authorization to sell up to $1.25 billion in Bitcoin and thoughtfully deploy their $2 billion in share repurchases. The STRC dividends are safely covered by the new US dollar reserve and their active trading profits. Ultimately, the outcome is a successful transition. They evolve from being a wildly volatile pure proxy for Bitcoin into a mature, actively managed digital credit enterprise. This would cause their stock to stabilize and trade much more like a traditional yield-generating financial institution. Finally, we must analyze the bear case, the absolute worst-case, pessimistic scenario. The trigger for this is a sustained crypto winter, where Bitcoin crashes significantly below current support levels.
The nightmare scenario. What happens to the stock if crypto totally tanks?
If this risk materializes, those high-yield 15.4% STRC dividends quickly become utterly toxic to the balance sheet. The company simply cannot generate enough organic cash flow from their $58 million software side to maintain billions in dividend obligations. The market would entirely lose confidence in the digital credit framework. The catastrophic outcome is that Strategy Inc. is forced to aggressively liquidate massive portions of their 843,000 Bitcoin holdings at severe losses simply to cover their debt and preferred dividend obligations. This forced selling would likely trigger a massive downward spiral in their stock price, and due to their size, it could potentially ripple out and crash the broader crypto market as well.
Wow. That is a terrifying possibility, and it perfectly lines up with this quote we have on screen from Yahoo Finance analyst David Farrell.
He says you should never be putting risk onto your balance sheet that has to rely on the price of something going up within a certain time frame. The data completely supports his assessment. Strategy Inc.'s entire $61.6 billion balance sheet, and specifically their massive $10.5 billion STRC preferred offering, is structurally dependent on Bitcoin either holding remarkably steady or going up. Leverage demands perfect timing. The sudden authorization to sell $1.25 billion in Bitcoin is a very clear empirical admission from management that they can no longer rely solely on the price of the asset going up indefinitely to fund their operations. They have introduced a massive timing risk into their corporate structure.
So what you just said basically means the market is watching with bated breath to see if their timing is finally right or if the clock has officially run out on this massive crypto experiment. It all comes down to whether this new framework is smartly shoring up the balance sheet to survive a crypto winter, or if they are permanently diluting the very asset that made them famous in the first place. I will leave you with a famous stock market quote from the legendary John Maynard Keynes that perfectly fits this company's situation right now. Markets can remain irrational longer than you can remain solvent. Let's see if Strategy Inc. has enough solvency to ride out this storm. Thank you for watching today's Explainer, everyone. Your subscriptions, likes, and supportive comments are a huge encouragement for our ongoing financial research and production. See you all next time.